Hey there, everyone. Dave Keller here, President and Chief Strategist of Sierra Alpha Research. I can't tell you how excited I am to be back here on Stockcharts TV. It's been such a pleasure spending time with all of you over the years, helping you better understand, better appreciate the markets, better appreciate the values of technical analysis and behavioral finance, and applying those lessons using the Stockcharts platform. Super excited to be back on a weekly slot here on Stockcharts TV. I'll hope to dive a little deeper into some of the macro themes that I'm seeing, some of the big picture observations, build on what I'm doing with my new daily market recap show, which I'll tell you about here in a short while. What today we're going to do is talk a little bit about market breadth. Because as the market gets into a mature bull phase, meaning we've had a consistent uptrend or a persistent uptrend that has lasted quite some time, and I don't think there's any denying here in early October of 2024, that is sort of the scenario that we find ourselves in. A couple pullbacks through the course of 2024, but nothing major, nothing really significant. So what happens, right? Well, the way that a mature bull market usually ends is that conditions start to deteriorate, and often conditions of breadth, or what we call market breadth indicators, usually start to deteriorate before the price action itself does, and starts to create these sort of bearish divergences that are very, very common at major market tops. What we'll do today is talk about three breadth indicators in particular: the McClellan Oscillator, stocks making new 52-week highs and lows, and percent of stocks above their 50-day moving average. Introduce those, each of them, and if you followed my work, you know that I've used these before. We're going to talk about using the three of them together. Then what we're going to do is do a bit of a history lesson. We're going to use the Wayback Machine and go back to the 2007 market top. And before we get too excited, no, I am not saying we have another global financial crisis happening in the next couple months. I don't know if I have enough evidence to back up that particular investment thesis, but I will tell you that by looking at historical market tops, we can get a better sense about what a market top going forward could look like. Then we'll apply that same lens to the current market environment here in October 2024, see what sort of conclusions we could draw. I thought this would be a fun exercise. I hope you find it enjoyable as well. Now, just to set the table here for this meal we're going to eat together over the next 20 minutes or so, I will just tell you that, the S&P 500, of course, has been making new all-time highs. And at the end of September, we again finished a month in a position of strength with the S&P closing above 5750. For the first time in the week that's happened since then. We've had a little choppiness, a little noise. And to be honest with you, since the S&P gapped higher above 5,700 for the first time, and that was here in mid-September, I think that was a key moment that day, and that was on economic data that came out a little better. It might have been the Fed meeting, actually, that now that I'm looking at the chart there. That'd be the Fed meeting, gapping higher, selling off on that Wednesday and then gapping higher that day after. That's what that was. We gapped above 5,700, and really in the two and a half weeks since, we really haven't gone anywhere, right? I mean, if you look, you can draw a straight line from that gap day, that Thursday, mid-September, to where we're at now, kind of getting into mid-October 2024, kind of around the same place. So the market really hasn't driven much higher during that period. But I would tell you, underneath the hood, which is what I think of as breadth indicators, the deterioration has actually been very real. This is one of those times potentially where the S&P index is holding up because of the strength in no small part of names like Meta and others that just keep making new all-time highs. But breadth conditions tell you not about the leaders, not about the generals, but more about the infantry, right? More about the individual stocks that comprise these indexes. What sort of message can we tease out by looking at their performance? So I would say for now, again, from a technical perspective, if you followed what I'm seeing, someone actually asked about an ascending wedge pattern. I don't have a problem labeling it that necessarily. I would say whether you call this an ascending wedge on the S&P 500 or just a rally of higher highs and higher lows with trendline support, in either case, whether this is an ascending wedge pattern or just a brief uptrend that you don't think you can label as a wedge for whatever reason, in either case, breaking this trend line from the August and September lows, I would say, is pretty much the signal. And I would say as long as the S&P remains above 5650 and also remains above this trend line support, the conditions are just not getting that bad. And we might chop around, we might have plenty of noise, but as long as we hold that level of support, that primary uptrend is still very much in play. We start to break those levels of support. That's when I would argue you really need to start thinking about potential downside targets how you want to protect yourself from those potential moves, and maybe set up for a great buying opportunity going into the rest of the fourth quarter, which, most of the time, average year, November and December, are actually remarkably strong after weakness in September and October. We haven't seen that seasonal weakness just yet. There's plenty of game left, as they say, here in October to deteriorate. So what information can we get? What data can we glean by looking at market breadth indicators? Well, we'll start just talking about breadth in general, right? Breadth conditions talk to you about, the strength of the stocks that comprise those major indexes, right? So if you want to get something deeper than just looking at the S&P or the NASDAQ or the Russell, you can start to measure the performance of the names that comprise those indexes. And I will tell you, having used a lot of different charting platforms over my career, I would say Stockcharts is one of the best, if not at the very top of their breadth data. There's a rich breadth database, and it goes back to, some of the great technical analysts like John Murphy, Greg Morris, Arthur Hill, many others that are fellow contributors here now more recently, and that have really built out the breadth platform on the Stockcharts website. As a result, I would say you're very well prepared, particularly analyzing the U.S. markets. There's so much breadth data available on Stockcharts to really make this assessment. So what does it mean when we look at market breadth? I would say the advanced decline data is probably the clearest way of demonstrating market breadth. The idea with market breadth is we are looking at the trend in the individual companies and we're aggregating them into one data point. So instead of looking at 500 individual charts, let's look at the trend in 500 charts, boil it up into one main data series, and then just track that series over time. And the most basic way I would say to do that is by using advancers and decliners, or what we call the advanced decline line. The advanced decline data is driven by the daily movements of each of the members of these four different buckets of stocks. The New York Stock Exchange on the top, S&P 500 large cap, S&P 400 mid cap, and S&P 600 small cap, and looking at the performance day over day. How many stocks closed up? How many stocks closed down? You keep a cumulative running total, and that turns into this cumulative advanced decline line. What's happened now, as you can see, over the last quarter, I would say in mid sort of spring into early summer, the advanced decline data was actually slowing down a bit. You see a number of times where these AD lines went below their 50-day moving averages, which is not the end of the world, but definitely suggests that the pace was slowing down a bit. But if you look at what happened July into August and September, even with the markets in terms of the S&P 500, the NASDAQ selling off a little bit, showing some choppiness, the advanced decline data actually remained quite strong. And I would say one of the great signals to remain bullish in July and August into September was the fact that the advanced decline data just kept trending higher. And this is sort of the trend in the stocks that comprise those indexes. A lot of times at the end of the move, there will be a bit of a disagreement. But for now, the breadth data is very strong, which means a lot of stocks are going up. And by definition, more stocks going up than going down over time. That's pretty bullish. Now, this is a lot of information to digest, and so we can simplify it a little bit. This is the first indicator we're going to talk about, called the McClellan Oscillator. This is a color-coded chart that I'm just showing where the McClellan Oscillator is above or below the zero threshold. So above zero, it's in green. Below zero, it's in red. If it's just a one-day thing, I kind of ignore that. I'm just trying to simplify, but keep in mind, I'm just trying to generalize with this particular chart. And the S&P 500 is at on the bottom panel for reference. Now, as we can see here, generally speaking, when the McClellan Oscillator is above zero, we're usually in an upswing for the S&P 500. When the S&P when the McClellan Oscillator is below zero, we're usually in a bit of a downtrend, and that's not always been the case. And if you look at the times when the McClellan Oscillator has been below zero, but the trend in the S&P has been higher, that usually means the mega cap growth names, the Magnificent Seven stocks, those big, market dominating names are doing well. And when they're doing well, even when breadth conditions are a little weaker, the market can still hold up okay. And you're arguably seeing a bit of that right now, sort of fast forwarding to the punchline, because the McClellan Oscillator just dipped below zero at the beginning of October. The S&P, as you know, is still holding that 5650 threshold, still holding support and trendline support, despite the fact that breadth conditions are starting to break down. I think this is sort of the meta effect, right? Some of those leading names still doing well, those big mega cap names holding in there, is actually allowing the benchmarks to remain quite strong, even if the breadth starts to deteriorate. Now, what we'll see when we look back at the 2007 market top, that can work for a while, but eventually deteriorating breadth usually becomes reflected because once investors finally sell out of those safety stocks, they're just trying to get out of the way of a potential downtrend. That's when a waterfall decline can start to happen. So the McClellan Oscillator is basically measuring changes in the advanced decline lines. As we can see, it did go below zero about a week ago, we'll call it, here in mid-October. Last couple times it's gone below zero. It hasn't been that negative, right? The S&P has sold off a little bit, but it's recovered soon after. And when the S&P, when the McClellan Oscillator has gone back above zero, that's actually been a great confirmation that the next leg higher is sort of is well into play. So first thing we'll think about is the McClellan Oscillator. Second thing we'll talk about are the new 52-week highs and lows. Now, I just launched a new podcast called Market Misbehavior, and had a great discussion last week with Mark Newton. I have a couple other really good interviews lined up, actually a bunch of interviews in the next couple weeks to continue to build out that podcast. So I hope you can tune into it for sure, and I'll share with you in a moment how to do so. But one of the things I talked about with Mark Newton of Fundstrat Global Advisors is the amount of stocks making new 52-week highs. This chart is the S&P 500 at top, the net difference of new 52-week highs minus new 52-week lows on the New York Stock Exchange. Then we have the broken out individually, new 52-week highs in green, new 52-week lows in red, and that's looking at the entire New York Stock Exchange. Bottom panel, new 52-week highs in green, new 52-week lows in red, just for the S&P 500. Obviously a more focused list of mega cap and large cap names listed in the U.S. So what do we see right now? Well, if you look at the chart over the last couple weeks, you can see that while the S&P has indeed made a new 52-week high, new all-time high, in fact, getting above 5,700 for the first time, look at the trend in the other three data series. Those three panels below are all trending lower, which suggests that while the S&P is holding its ground above 5,700 for now, there are less and less stocks making new 52-week highs. Now that is a bit of a concern because in a healthy bull market phase, you want an expansion in new highs. You want more and more stocks, those leading names, those early adopters, getting to new 52-week highs and then remaining in an uptrend, which means they keep making new 52-week highs. But as the market continues higher, you want more and more stocks also eclipsing their previous peaks, which makes the new 52-week high number increase over time, right? As more and more stocks are participating. Toward the end of a move, what happens is there's still some stocks making new 52-week highs. And again, on Friday's close, 33 names in the S&P 500, so that's about 6-7% of the S&P 500 members made a new 52-week high. So that's not bad. But a couple weeks ago, here in mid-September, as we were pushing above 5,700 after the Fed meeting, we had about 20% of the S&P 500 making a new 52 high. So 20% down to around 6% is quite a change, right, in just a 2 to 3 week period. So this is what happens toward the end of the move. You still have some things that are working, right? The metas are still breaking out, but a lot of things that have been making new 52-week highs are no longer doing so. And that often is a concerning development toward the end of the move. Final breadth chart, and then we'll do a bit of a history lesson, is the percent of stocks above key moving averages. Now, I'm looking at the S&P 500 at top. I'm looking at the percent of stocks above their 200-day moving average, percent of stocks above their 50-day moving average. And you can see that percent of stocks above their 200-day moving average still holding around 74%. This one I don't pay a lot of attention to until and unless we break below 50%. This is more of a long-term breadth gauge. In a primary uptrend like this, as long as we don't get anywhere near 50% on that particular series, I'm not concerned about the long-term trend. I think any sort of movements we're seeing are probably still more short-term. When that breaks down, that's when you have to start, pricing in the odds of a much more significant, drawn-out corrective period. But for now, that's obviously telling us conditions are still okay. The bottom panel is the one we want to focus on, though. This is the percent of stocks above their 50-day moving average. Now, here's the S&P 500 itself, and this, of course, is above two upward sloping moving averages. So the S&P is above its 50-day. It's also above its 200-day moving average. So this is in a primary uptrend using that basic assessment. You're looking at the two moving averages. If you look at the last couple pullbacks we've had here, we've had three major pullbacks in 2024. We had a pullback in April, we had a pullback in July, and we have a pullback in early September right around Labor Day. And each one of those times, note how the S&P did break below its 50-day moving average, but never broke its 200-day moving average. That is sort of the moving average definition of a short-term pullback within a long-term uptrend, right? We're breaking the 50-day, which means we're selling off a bit in the short term, we're pulling back, but we're holding the 200-day moving average, which continues to slope higher. Long-term conditions are still not under question, right? The trend overall is still positive. So down at the bottom, we're basically looking at the 500 members of the S&P and making the same assessment on every one of those charts. Are they above their 50-day and above their 200-day moving average? Well, we can see as of right now, and this is basically midday here on Monday the 7th, we're around 74% of S&P members above their 200-day moving average. That's pretty decent, but we've gone down from around 85 to around 68% of the S&P that are above their 50-day, which means, what is that? What, 17% of the S&P over the last week were above their 50-day moving average and now are below. So that's not the end of the world. That's not everything going down. That's not doomsday scenario kind of numbers just yet. But it's certainly not as bullish as it was when almost everything, right? When 8.5 out of 10 were going higher, that's different than down to like 6.5 out of 10. And if we keep going lower and lower, particularly get below the 50% line, that's when more of a protracted corrective move can often happen. You can see that happens here in April of this year during that pullback, and very notably in August of last year when we sold off and ended up being a couple months of a more persistent downtrend. So those longer declines start as short-term declines, or what I always like to tell people, all large losses begin as small losses. So if we can have some signals that help us recognize maybe the initial movements, then what we want to do is start to track and see, okay, are we seeing further deterioration in these breadth indicators? What does this look like relative to historical market tops? And are we starting to see some similarities? We'll look here in a moment at the 2007 market peak, but before we do so, just a couple quick announcements for all of you. And again, can't tell you how excited I am to be back here on Stockcharts TV, sharing some charts and ideas with all of you and really celebrating some of the benefits of the Stockcharts platform and showing how we can use this robust analytical tool to make better investment decisions. First off, if you're looking for my daily market recap, it's back on, it's back up and running, and we've had some great success so far. Would love to have you join us live every weekday after the close, 4 p.m. Eastern, 1 p.m. Pacific. My new show is called Chart This with Dave Keller. We're running as a live stream on X, on YouTube, and on Facebook. So if you follow me in any of those places, whatever platform you use, you'll see it pop up every weekday at 4 p.m. Eastern with a live stream. I'd encourage you to tune in live. You can ask questions. We usually take a question or two at the end of every broadcast, but it's a great sort of a daily exercise of navigating the markets, debriefing on key movements, the key patterns, and what you need to know. The other thing I will tell you about is I'm doing a free workshop, a virtual workshop, a webinar coming up on Tuesday, October 15th. That's at 1 p.m. Eastern. We'll be talking about election season 2024 and what you could do with your portfolio now, what sort of things you want to think about as we get closer and closer to the big election day in early November, what sort of potential outcomes we could see depending on who actually wins this election, and what sort of market movements we can start to infer based on historical analysis of outcomes after Republican and Democratic leaders, and just some of the policy expectations that I think a lot of us will have. If you're concerned about the election, if you're a little bit nervous about what this might mean for your portfolio and what this might mean for the markets, hopefully our time together should help alleviate some of those concerns, or at least give you the tools you need to make better decisions between now and the end of 2024. You can sign up for that free event at marketmisbehavior.com/election2024. I hope you will join me for that free live webcast coming up on Tuesday the 15th. And by the way, as we get into the chart of the 2007 peak, as a reminder, my live stream, we run it every day on those platforms. I do have all of the recordings available soon after we run it on my YouTube channel, which is called Market Misbehavior. So hope you can tune into it over there. All right, to finish off our session today, we're going to talk about the 2007 market top and then make a bit of a comparison to the 2024 market top. Now, before any of you go out and start telling your friends, Dave Keller, who we all love, is talking about 2024 versus 2007. This is Dave's super calling the top here. He says the top is in. We've hit the peak. I don't have enough evidence to make that, and that is not the point I'm making here. What I am telling you is we can learn a lot by going back to previous market peaks and actually learning from them, right? Charts provide such a fantastic history lesson, and what you benefit from by having a platform like Stockcharts is a pretty rich and deep historical database. The fact that we can go back to a 2007 market top, look at what the charts looked like at that point, look at what these breadth indicators did, and then use that experience, use that history lesson to then apply it to the current markets. What a fantastic resource we all have available to us. So let's do it now with the 2007 peak, and then again start to draw some comparisons with what we're seeing now. Now, I've highlighted what ended up being the eventual peak, which was in October of 2007. Now, if you know your market history, you'll know that this was when the financial crisis, it turns out, was beginning. Really didn't know at this point the scope or the impact or all the ripple effects that this was going to create. Really, I mean, to this day that we're still feeling the aftermath of and feeling the pain from this period. But this was still sort of in the raging bull phase of 2007. Now, a lot of things had already started to come down, and we'll note as we look at the breadth indicators, when the breadth indicators start to get negative, that means a lot of stocks you were probably holding in your portfolio were already starting to rotate lower. So even though the S&P was making new all-time highs in October, a lot of stocks actually were not making new all-time highs. And the small cap index, the Russell 2000, I remember, specifically not making a new high while the S&P did. And that's one of the many things that sort of suggested maybe that uptrend was getting a little overextended. Again, what happened afterwards, I think, was much more. You're able to track that over time using some of the traditional trend following techniques that we use. But I think particularly at this peak, what could have told us in September, October, November that even though the S&P was making a new all-time high, that conditions were not as good as you expected them to be based on that reality. So these are the three breadth indicators that we just talked about. The McClellan Oscillator, I switched the order of these last two. I didn't mean to do that, but here I did it. So the percent of stocks above their 50-day moving average, and then the new 52-week highs and new 52-week lows. So we're looking vertically at the October 2007 high, and then these three indicators. Look at all those conditions that we talked about looking for here in 2024, and look how they all played out basically in October of 2007. We had the McClellan Oscillator, which went above the zero line here in August, which suggested, nice short-term breadth, constructive. Then we finally broke below it here in mid-October. So the McClellan Oscillator went from above zero to below zero, as we saw in the earlier chart. And again, had some issues this over the last year for sure. It wasn't perfect, but more often than not, that swing below zero, particularly when it's been above for a while, is often sort of it tells you something's different, right? What we call a change of character in the chart. Something looked a certain way, particular configuration before then, and now it's changing. The pace of the advanced decline lines are evolving lower, and that's why the McClellan Oscillator dipped below zero. Look at how almost on the same day, we can see the percent of stocks above the 50-day moving average, which had swung above 70%, which I see as sort of a euphoric level, came back below here in third week in October, really right after what ended up being the eventual peak. So what that says is that almost all stocks in the S&P were in a nice uptrend above their 50-day, and then things started to break down. Before all was said and done, and we had that January 08 low, we got all the way down to below 10%. That's what happened over the next 2 to 3 months. And so these indicators can certainly get negative very, very quickly. And that's why keeping an eye on like the 50% line can help us differentiate on, okay, this might be something even more significant than we've experienced so far. Also note right here, right? We had the big expansion in new 52-week highs for much of the first half of 2007. It lightened up a little bit in August, and then we had this run higher in September, October. Look at what happened here as we saw less and less new 52-week highs. By mid-November, that had completely dried up. And look at the new 52-week lows, which got more and more and more. Again, finally going to an extreme number of stocks making new 52-week lows as we made that January 08 low. And it was even lower then than it was later in July and September of 08, before the eventual low in Q1 of 2009. But you can see that initial change from a lot of green and no red to a bunch of red and very little green. And that is why the less and less stocks making new 52-week highs thing, what we talked about earlier, and as I mentioned in my discussion with Mark Newton, This is why previous market tops have tended to be like that, where you have less and less stocks making new 52-week highs. The market still held up, right? So the S&P was still around 1550, which back in the day was a really high level. Seems kind of quaint and small now, but it really was at that point. And then again, all of the deterioration happened after that. The S&P broke to new swing lows, broke below the 50-day moving average. The moving averages are sloping downwards. All of that happened after the breadth indicators started to turn negative. Just to finish off the show here today, let's go now to the current market environment. Now, we looked at each of these indicators separately, but now let's look at them in that similar feel. Here we have the S&P making a new all-time high in September of this year. You can see the McClellan Oscillator, which had not been above the zero line for long. That's fair, but it did just break back below the zero line at the end of September. We have the stocks above their 50-day, well above 70%, breaking down below 70% going into this week. We have less and less new 52-week highs. What we don't have yet are a lot of new 52-week lows, but I think for me, the bear scenario for October, if we play into that normal seasonal playbook of weakness in October into strength in November, December, despite what happens in November, December, the weakness in October, I think would be marked by the McClellan Oscillator remaining largely below zero, with the percent above their 50-day getting much lower than it is now, maybe even below 50%. Less green and more red, indicating less new 52-week highs and more new 52-week lows. What do you think about this brief history lesson of breadth indicators, comparing the 2007 market peak using these three breadth indicators to what we're seeing now in October of 2024? Please leave me a comment below and let me know. For Market Misbehavior and Sierra Alpha Research, I'm Dave Keller. Have a great one. We'll see you again next week.